You're free and ready to go and take off with the show.
Okay, thanks, Michelle. Thank you, everybody, for joining. My name is Brian Shannon, and if you know me, my work is done at alphatrends.net, and I have a pretty good following over at Twitter, where my handle, I guess you would call it, is @AlphaTrends, and I'm the author of this book that came out about a year and a half ago. I've been trading equities for about 17 years, basically right out of college as a retail broker, then started actually full-time trading for myself and in hedge fund and prop trading, that sort of thing, about probably 13 years ago for actual full-time trading. But the reason that I was asked to join this today is because well, one, I have a good friend of mine, Ferry Hamzy, who's organized this, and I respect his work a lot, and I guess he does as well for mine. But and also I wanted to say, thanks for being here. I know it's been a long 3 days of taking a lot of information in, and it's the end of that third day, so I'm sure a lot of you are tired. But I'll try to keep it at a good pace here. What we're going to talk about is, and again, I'm more of an equities trader than options. I just have to show you this screen here as well. Just a standard disclaimer from the SIBO. You've probably seen it a couple of times here already, but I'm just going to leave that on the screen while I talk so you can read it. Nothing here is financial advice, but we're just going to talk about selecting equities and what I call trend alignment. It's really using multiple time frames for trend alignment. That was the name of my book as well. But I'm a big believer in options trading for myself. The way I do it is I'm a buyer of premium, and I'm sure that probably contradicts what some other people might have said the last couple of days. But not all options expire worthless, and I think there's something to trade as well. I trade them on individual stocks when I think that there's one, maybe an event risk, basically, and I realize that the premium of the options gets inflated ahead of events. But sometimes if I see just a really good setup in front of earnings or something like that, and the perceived value of the option is in line with what I think the stock may do, then I will I'll make a speculative bet there. What I really like to do, though, is really like next week, basically, the week of options expiration, the third Friday of every month. Obviously, options expire. Next week we have that event occurring, and what I look for is I look for swing trade setups in terms of stocks that I think might be able to move over a course of 1 to 5 days. And to me, it's a risk mitigation strategy where I can look at an option and think that, if a certain stock is going to move, I think, what I can do, actually, let me share my my Realtick screen so we can take a look at an individual stock that might be considered something. And look at that SPY closed right at that 109. I was talking about it being the pivot and the location of the 5-day moving average, as well as this prior support from Tuesday midday, but they magnetized it right to that level. Anyways, what I like to look for, basically, and I'm just going to give you kind of a preview of kind of what I look at, and then we'll go into the PowerPoint here a little bit more. So anyways, let's take a look at let's take a look at a stock I was talking about this afternoon. This is called Bunge Limited. I don't know how to pronounce it. BG is the symbol, but on a weekly time frame, you can see here. Let me just get this trend tool. We've got we've got this chart here. We're looking at a weekly chart of the symbol BG. You can see it's broken its trend line. It's got a lower high here on the weekly time frame. It's below all those moving averages as well. So it looks like a good candidate to continue lower. So you can see right here, this black line is a 200-day moving average, and it just seems to be stuck underneath that. Now, I day traded this stock today. I tweeted that, but it started to break down here. If I was thinking that maybe this setup had occurred maybe on Monday, let's just pretend it's Monday of next week, the 16th, or even Tuesday the 17th. This is the type of stock that I might look to purchase options on somewhere over in here. So if there were, not necessarily maybe this one, because I think the best strikes would, the strikes in here would be either 60 or 55, and those are too far away. But let's say that, again, just to make things up, if the stock was trading at $56.50, at that point I might buy 55 puts that expire on Friday. At that point I could probably pay, I would be guessing, if it was Tuesday of next week and the stock was 56.5, this is just a complete guess, I bet I'd be paying probably about 50, 60 cents. So it would have to drop, down below 54.50 in order to make money. And I realize I'm kind of probably screwing you up by, I told you I wasn't going to try to keep it easy because I knew you were tired, so I apologize again here. But to me, this is the type of stock that looks like it could head down towards that 55 level here. So if it was the other price that I had made up previously, then it would be a different scenario. Anyways, I've caught myself getting off track here. What I want to do is take you back to the PowerPoint, and we'll go through the material here, and basically what it's meant to do is just to give you a better idea of what stage is the stock in. Is it in an uptrend? Is it in a downtrend? Is it sideways? And then it's up to you to determine the appropriate option strategy that you've learned about the last 3 days to decide whether or not you want to be involved. For me, it's about trend trading. But I wanted to give you a little bit of just some statistics here, I guess, about the market lately. This is just something I put together by building an Excel spreadsheet, and this was through, I guess it was through September of this year. The average daily range of the S&P 500. So you can see here that obviously 2008 was a very volatile year. Now I'm not talking about the VIX. I'm not talking about measurements of volatility based on options premiums and that sort of thing. But what I'm talking about here is the actual range of the S&P 500 from high to low each day. So this year, year to date, as of September, it was 2.27% from high to low. For last year, it was about 2.9%, which is obviously, you can see here, the biggest volatility we've seen in a decade. So we have higher volatility, and that's a good thing for traders. I think we're in a great environment for trading. We continue to see all kinds of volatility. And if you take a look here at this next chart, what this is something I put together back on October 1st. It takes into account September's or through all of September's trading. But what this does is it shows the monthly range of the S&P 500 at the SPY here. So from high to low. And what I did was overlay that on the SPY chart here, so you can see that we've had these huge ranges here from high to low in the S&P 500. If you take a look at the 25 largest here over the last 10 years, we've got, October of 08 was the biggest, 28.7% range of the S&P 500. Then November of the same year was 27%. But this year we've had one, two, three, looks like four, maybe four or five of the most volatile months of the last 120 months or 10 years. So, again, it's more of a statistical look at the market and what kind of environment we're in here. But this is, how that volatility occurs as well. So this is something I had done actually last year. I haven't updated it this year, but it's still relevant because we all know about the distribution of volume and volatility, or maybe we don't all know about it. I shouldn't make those assumptions. But the most volatile periods of the day tend to be towards the beginning and the end of the day. That's something that everyone kind of has in their mind. And the middle of the day, when it kind of slows down, people go to lunch, the programs start compensating for lighter average volume as well. So it becomes a self-fulfilling prophecy as far as that goes, because the buy programs and sell programs, or the algorithms that might be going in to buy a million share order of Intel today, they will look at the average volume by period. Here in this case, it's 30-minute periods for whatever market they're looking at, and they'll say, well, only this much of the, only 10% of the volume occurs midday, so let's slow our program down to buy only 10% of it during the day. So again, it becomes self-fulfilling as far as that volume distribution goes throughout the day. But the volatility here, you can see that for last year, it was the last half hour that really was the most volatile. January of this year started out at the beginning of the day was a little bit more volatile, and here we have actually. I did update these. I had forgotten that this was the next slide, but this is what I did was I took a look at not only the percentage range of the SPY over these 30-minute periods, but also a look at the volume as well. So you can see obviously the majority of the volume comes in during that final 30-minute period from 3:30 p.m. Eastern to 4 p.m. Eastern. That also happens to be the biggest volatility as far as range goes. Not necessarily up and down, but at least the range. It could be obviously more volatile, but it's most likely that this is the most volatile period because it has the highest percentage range. So just kind of more interesting information about what the market, how the market works during the course of the day in terms of where the volume and the volatility are. There's not a whole lot of value in these types of charts. I don't think the one on the right. And that is what I did was I took a look at the average percentage movement by half hour. So the average, since January 1st. Now the problem with this type of quantitative analysis in my mind is it assumes that all market conditions are the same. So what I think is more appropriate to look at is something, for instance, like if we look at the average range by half hour, if the market is above or below a constant, such as maybe a 20-day or a 50-day or a 5-day moving average. So when the market is above a rising 50-day moving average, how does this get skewed versus if it's below the 50-day moving average? Because obviously we began this year with the market below the 50-day moving average on the SPY, and we crossed back above it in March, obviously, and so we started out the year in a strong bearish environment, and I would bet that this gets a little bit skewed. So the reason I wanted to bring this up, because one, it's somewhat interesting, but two, I think when you look at any of these statistical types of analysis, that you have to consider that it's not always comparing apples to apples, because you can't compare the range of a bull market and a bear market together. They're separate beasts, so to speak. But anyways, just a little bit of interesting information. Here's something else that a lot of people have been talking, not so much lately, but about the the Dow Jones back in 1929 to 33 when we had the bear market. This was the crash right here, and this is just some interesting information. If you look at the direction of the 200-day moving average, all the rallies pretty much failed while the market was below the declining 200-day moving average, or while the 200-day moving average was declining. The 200-day moving average flattened out right here in 33, not at the bottom, of course, but then a subsequent rally began. Now we're above the 200-day moving average. We've been above the 200-day moving average of the S&P 500 since late May, and that's where this rally is coming from. Still, a lot of people are looking for the top of this rally, and so far the evidence just isn't there. We have right now still we have a strong bullish environment in the S&P 500. If you take a look at the weekly time frame, we've got this downtrend line. We can take a look at Fibonacci from the 2007 high. Let me just redraw that from the 2007 high to the 2009 low. We're approaching a 50% retracement. That 50% retracement, that is of this entire range, that 50% retracement is also approximately equal to the same area where we see that downtrend line. So we're coming up to an important level in the SPY, and we'll see, if that brings about sellers. What we can't do is we can't look at it and say, well, that's where resistance is. Well, that's where the potential for resistance is, but we don't know till after the fact, until the market has basically turned away from there and started to decline. Then we could look back and say that was resistance. We have the potential on a bigger pullback that this prior resistance in here will become support. But again, on this weekly time frame, and I don't mean to talk too much about the market itself, we still have higher highs and higher lows. Even, this week we've had a higher low. Last week we held on to a higher, this week we have a higher high. Last week we held on to the higher low. It's only when you look at the 1 minute and the 1 and 2 day charts that we start to see any evidence of a downtrend. Looking at a 10-minute time frame, still in an uptrend, right on this trend line, right on the 5-day moving average and that sort of thing. So we have to be careful, in other words, to make these comparisons, because we have to look at them and say, well, how do we keep them constants? And for me, it's all about using simple technical analysis to look for evidence of trend or of sideways activity and determine whether or not I want to get involved. What drives stock prices? What drives the market in general? Well, obviously the news, the fundamentals, the sale, on a company-specific basis, its sales, its earnings, its PE ratios, and I see sometimes people talking about basically saying technical analysis, haha, what a joke. And to me, that's a real closed-minded opinion, not because I use technical analysis for 95% of my decision making, but because it's like a lot of things in the market, it tends to be a self-fulfilling prophecy. And I'm not here to sell anyone on technical analysis or unsell fundamentals, because I think that ultimately, yeah, the economy does matter, and whether or not this company is selling more stuff, that is, are their revenues are increasing, and are they bringing it to the bottom line? Are they making more profits, and is it reasonably priced compared to historical measures of value, such as a PE ratio? I think those are important pieces of the puzzle, but it's a large, complicated puzzle with a lot of moving pieces, and just as you can't look at 50-day moving average and make all your decisions based on that, you can't look at stocks and say, well, it's above the 50-day moving average or below the 50-day moving average, so I'm going to make all my decisions based on that. It simply isn't that simple. Just as they say technical analysis is more of an art than a science, I think the same goes true for fundamental analysis. Trading is an art. Investing is an art. There's a lot of smart money out there who knows more than us, who has done more research, who is better prepared, who has better computers, higher IQs, and that sort of thing. But what we want to do is we want to understand really the psychology. What is the psychology of what makes people move, change their mind and make the decisions to buy or sell? The market is constantly seeking fair value. It expands in price direction to either find a source of supply to slow its ascent down, or it expands to the downside in search of buyers. That's what the market does. That's the job of the market. You look at things and people say, well, this stock is undervalued or it's overvalued. You have to say, compared to what? Compared to a historical norm, compared to the 100-year storm. This only happens every once in a while or whatever. Larry Summers was on TV about 3-4 months ago, and I thought he said something real smart, which was, listen, we've been talking about and risk and measuring risk in the markets based on the 100-year storm. Well, if you haven't noticed, the 100-year storm, he said, has hit us basically once every 2 to 3 years, with the tech bubble, with long-term capital management, with the Russian thing, years ago. It's always something new with with this market and our economy. There's always some, the 100-year storm keeps hitting, and that's what really makes our job our number one job. And I'm gonna talk about somebody else in that regard. That is that one of the best things I ever heard Alan Greenspan say was one time when he was before Congress. He was talking to the congressman and saying. He was saying, here's what I view my job as. I view my job as risk manager for the economy. And I thought, that's pretty smart. He's managing risk, and that's our job as well. Our job as traders and investors is to manage risk. Whether you do that by being a real good stock picker, by having good option strategies to make sure that you're hedged and that I'm not even going to try and talk the options language, but to make sure that you're hedged appropriately and you're in the right vehicles to begin with. That's what we want to come up with and try to understand who's in control. Are the buyers in control or the sellers in control? This is the cycle of psychology for long participants, basically, that you don't want to get stuck in. This is how amateurs approach the market. Now, we're looking at a chart here that actually this is just something I put together actually several years ago. This is Cisco Systems, through I don't know, maybe 2005. I really don't remember, when this chart ended. Basically, I guess it was about 2003. So I think it was about 1996 to 2003. And this type of pattern, you look at it and say, well, it's Cisco. It's from this chart's 5 years old. Well, it's 5 years old, but the concepts are the same. Whether you're looking at a chart like this one where the candles are constructed with weekly price bars, or whether you're looking at a 1 minute candle of the ES contract, you can go through all of these emotions in one day. It depends on how you approach the market. If you're leveraged way up in the S&P 500, believe me, in the morning it might be long. You're thinking you've got it made. You get that greed, you get that real greed feeling, and you don't start to let go. You think, well, the market's coming in. This is the midday. Maybe it's starting to come in. You start, telling yourself, well, it's just midday doldrums. It's low volume. Then it starts breaking down, and you're thinking, oh, well, now I'm at a loss. What happened to my big gain in here? You start to panic, you capitulate. Depending on how you approach the market. Now, if you're a day trader, again, all of these emotions will occur during the course of a day if you let them. If you don't have a plan, if you don't have a strategy for looking at and assessing risk at the current moment, not relative to a PE ratio, not relative to what Warren Buffett might think is a value, but relative to the only thing that should matter to you, your account. We're in it for ourselves. This is a selfish endeavor that we're involved in, trading, but we have to look at it objectively and say, well, as the market rallies, it's nice to be making money, but I need to peel some risk off. I need to reduce my exposure. I need to make sure that if this market does pull back, that I still have some profits left. And having strategies and just looking at definitions of trend, higher highs and higher lows, like we just did it with the SPY. We're still in an uptrend, so trying to put big short positions on that are going to be, you think maybe held for the next 6 to 12 months, it just doesn't make sense. Not yet. Not until the market starts to roll over and then start to show us some lower highs and lower lows. This is, again, through the end of I think it was October. We're at 109 now. This is at 102. But we were in an uptrend. All of the moving averages were heading higher. And you have to look at these macro cycles and say, how much value does this have to me as a day trader? Really not much. But you want to be aware that when we're in an uptrend, the path of least the rising tide will tend to lift most boats. So some of them have little holes in them and are leaky and won't experience the same type of rally as the overall market. But when you look at it, the average stock is heading higher right now. So while we're in an uptrend, whether in the market or that individual issue, the path of least resistance is higher, you want to be long. Generally, of course, there's going to be pullbacks in there, and yes, you can make money selling short the rallies in an uptrend, but I guarantee you this, the sum of the rallies is always going to be greater than the sum of the declines. Otherwise, we're not in an uptrend. Once that definition of trend has changed, then you have to reconsider, examine the risk, and say, why am I still involved in this trade? So that was looking at a monthly time frame. We're now looking at a weekly time frame here. We might as well just take a look at this. I was going to switch it back to a live look at the market, but I don't want to again get too far off base here with this presentation, because we only have another 35 minutes or so. But basically, when I look at the a weekly time frame, some of the more commonly used moving averages are a 50-day moving average, a 100-day, or even a 150-day, and a 200-day moving average. Those are considered pretty standard, I think, right? So on a weekly time frame, what I look at is a 10-week, 20-week, and a 40-week moving average. Okay, the 40-week moving average obviously is going to be equal to a 200-day moving average. So when I see, because there's 5 days in a week times 40 days, so we don't put a 200-period moving average on a weekly chart, because that would give us the average price of 200 weeks instead of 200 days that we're interested in. Why are we interested in the 200-day moving average and the direction of the 200-day moving average? Because that's what the big institutions look at. They say, the bulls live above the 200-day and the bears live below it. What's more important, I think, is the direction of the 200-day moving average. When the 200-day moving average is declining, you generally want to look at rallies as guilty till proven innocent. Doesn't mean they can't turn like they did here. We had this March, rally from the March lows up to the 200-day. It rallied, pulled back, and then tested that 200-day as support. Now we've got a rising 200-day moving average. It's innocent till proven guilty. That's on a weekly time frame. That's much longer term than anything I know that I do. But when we're below the 200-day, these rallies, like we see, like we saw in early 2008, come right up to that declining 200-day moving average, and that's similar to what we were looking at on the chart from 1929 to 1933. So we have just generally, weekly with a 200-day moving average or 40-week moving averages declining, guilty till proven innocent. Now, when we start to see, the 10 and the 20-week moving averages crossing, so 10 comes up to the 20, it's saying, well, the short-term trend on this time frame is measured by the 10-week moving average is turning higher, but the 40-week moving average is turning lower. So what does that tell us? That tells us that we have mixed messages on this time frame. And when we have mixed messages, what we want to do is we want to look at the market and we say, either moving average crossovers, in other words, represent indecision. They don't give us a reason to buy or sell. They tell us that the direction is starting to slowly shift, something internally. The short term, the buyers are in control. So what we want to do is we want to drill down to shorter term time frames and make sense of where this market could be turning. Here we have another weekly chart. This is kind of just to show you, what, and this is a real chart. This was the SMH, I believe, maybe a year and a half, 2 years ago. I don't remember the timing on this. But on this weekly time frame, again, it's a 10, 20, and 40 week. But just look at it and forget about the time frame here for a moment. This could be a 1-minute chart. This could be a 30-minute chart. It could be a daily chart, meaning, it could be constructed of 1-minute candles or weekly candles. What we have, though, is the way I like to look at the market is I like to look at 3 different moving averages. I'll tell you which ones for different time frames here shortly. But when we have the moving averages crossing back and forth like we have right in here and we have in here and then up in here, it tells us that there's indecision in this market. Whereas when all the moving averages are rising and the prices are above those moving averages, it says we have a solid trend here. What is the direction of these moving averages? What's the direction of the highs and the lows? Higher highs and higher lows. Early in an uptrend, the short-term moving average tends to act as support, meaning that buyers will tend to congregate near that. That doesn't mean you buy there. It means that when it gets to that 10-week or 50-day moving average, it means that we want to drill down to a shorter term time frame and see if there's evidence that the buyers are actually starting to take control. When we have indecision up in here, it says, well, where have we come from? Where do we have the potential to go? Well, we just rallied from 22 to 44. We just have a market that doubled. Now we're showing some indecision. Short term, the sellers are taking control. We're neutral in here, but have the potential to turn lower if we break support. We break support, all the moving averages are turning lower. It's guilty till proven innocent. Then we have back and forth activity. We start to see some higher lows in here. We break resistance at the 34.5 level, and we've got all those moving averages heading higher. Now it's innocent till proven guilty. Does it mean that this rally will continue higher? No, but it puts us in the right direction and tells us that now we want to generally be long in here with stops in place. We still have to manage risk no matter what we're doing. We still have to manage risk. Here's a chart of, I believe this is Baidu, BIDU, just based on the price. You can see here that we've got a 10, 20, and 50-day moving average on the daily time frame. So we had in here indecision, stage 1. This is, if you look at the classic Stan Weinstein book, Secrets for Profiting in Bull and Bear Markets, he's the one who kind of popularized the whole, stages. They were actually Michael Kerr, I think, was his, or Joseph Kerr, Method in Dealing in Stocks, first really came up with the 4 stages. He didn't identify them with numbers and that sort of thing, but that's the earliest I had seen them. And I think his book was maybe in the 1920s or 30s. It's an older book though, for sure. Anyways, when we look at what do we call stage 1? It's called accumulation. So when this accumulation occurs, and we have let me just do something real quick here to this PowerPoint. How do I don't know if I wanted to do that or not. I just, I was trying to look to see if I could find a drawing tool so I could draw on this chart a little bit, but it doesn't appear as though I can do that. So I'm just going to keep it in this way. But just follow my mouse along in here where you see that arrow. Basically, we have this resistance at the 140 or so level. So we had indecision here. We had that 50-day moving average come down and start to flatten out. We had the 10-day cross above the 50, the 20-day cross above the 50, and then right here, right where my mouse is right now, that's the point where we had a higher high with the 10-day above the 20 above the 50. So in my mind, that's the higher high that leads to an uptrend. How high do we expect it to go? Well, we would, if we didn't see March, April, May, June, July, and August and September, we would look and say, well, here's a prior support. Let's look for potential resistance near there. And if it continues to rally up through there, what are the next levels of potential resistance? Because this stock obviously showed no slowing down, just continued to rally. So when I look at a daily time frame, even when we have that indecision in here, when I look at a daily time frame and the indecision occurs with the 10 and 20-day crossing, I still look at it as innocent till proven guilty because we have an advancing 50-day moving average. The direction of the 50-day moving average, even when we get below it, that's a lot of times a trap for the shorts that we see that people, amateur technicians, will look at it and go, hey, Baidu's breaking down. It closed below the 50-day moving average. It broke below that low. A lot of times it turns into a short-term trap where we suck the shorts in, we get rid of the weaker longs, and then they squeeze it higher very quickly, which is what happened in here. So with a declining moving averages, we're in stage 4. After a stage 4 decline and we start to see back and forth activity, we look at it and say, this looks like the potential for accumulation. So what do we do with it? Well, basically, we're in observation mode. We watch to see if it's going to break out. To me, I have no interest in the neutral stocks, the ones that are turning sideways. I realize there's some great option strategies in there, but that's not my personality. It's up to each person to determine what's the most appropriate way to get involved for you personally, and look at that and say, okay, I like the neutral stocks. I'm gonna write puts and calls, do strangles. Anyways, we can look at an hourly time frame, and actually, when you look at a chart, let me just tell you this: don't look at hourly charts. Don't look at 60-minute charts. Why? Because the market, I'm talking about equities here, is open from 9:30 a.m. Eastern to 4 p.m. Eastern. So it's open from 9:30 to 10 is a half hour, then 10 to 11, etc. We have 7 periods. You would have 7 candles basically on an hourly time frame. 6 of those candles are equal to an hour. One of those candles is 30 minutes. So we're comparing 6 apples to 1 orange. It doesn't make sense. We give unequal weightings to our moving averages. So instead, what you want to look at is either look at 30-minute time frames where we have 13 equal 30-minute periods over the course of one day, or you could look at a 65-minute chart rather, where each candle is constructed not with 60 minutes but 65 minutes. That way there are 6 equal periods of 65 minutes or 390 minutes, which is equal to the course of the day. Anyways, same thing we see here though. When we have the moving averages crossing back and forth, we have right over here declining moving averages. We're in lower highs and lower lows. We're in a downtrend. And then it starts to turn a little bit more neutral. The stock breaks out higher highs and higher lows. Stage 3 accumulation. So, what I like to do is I like to find ideas like this one on options expiration week that are in that late stage 1, look like maybe they're going to break out, and I can buy a call, and I can buy them pretty inexpensively. What I generally do is I buy the stock and the call. I like to buy the stock, and as soon as the stock starts to move, I take some profits in it. I hold some more of the stock, and then I hopefully can pay for the option by taking the profits out, and I'll hold the option maybe for 2 or 3 days, whereas I'll day trade the stock. That's my personal preference. But what we want to do is we want to make sure that, like we see in this stock, these are 65-minute candles. We have this high here at about 33.50. We have this high at 34.50. We have this low at 30.5, then 32. So what does that tell me about the daily time frame? The daily time frame says we're in an uptrend. We're in a stage 2 uptrend. This was a pullback within. So what we're going to start to see is we're going to start to look for the alignment. So here's a 10-minute time frame, and we can look on the 10-minute time frame and look at the same type of moving average crossing back and forth equals indecision rather. Typically after a rally it will be distribution. After a decline will typically be accumulation with the stock setting up for the next rally. Even on a 1-minute time frame we see all of those same 4 stages, and what we'll start to talk about though is looking for what I think is where we have the highest probability and lowest risk, which is when we have the trends aligned across multiple time frames. Charles Dow, obviously the father of, they say, technical analysis, came up with the Dow Theory back in the 1920s and 30s, and he said there's three trends in the market at any given time. The primary trends, they can last for years. The secondary, maybe 2 weeks to 3 months, and the short term, insignificant ripples of maybe 2 weeks or so. Now that's really where it comes up with this this idea that I call trend alignment. And I'm not claiming I invented anything here. I'm just kind of putting it in my terms. And what I like to do is I like to look at the long-term time frame. So in my case, as someone who's primarily looking for swing trade candidates, I consider the daily time frame for the last year or so to be the long-term time frame. So the long-term trend, and on that long-term trend, I'm looking, time frame. I'm looking for potential candidates. I'm saying, where are we in relation to the 50-day moving average? Are we above it? Are we below it? What's the direction of that? Okay, we're above it, and it looks like we've pulled back and found support recently. Now I need to look at the intermediate term time frame, either a 65-minute time frame or a 30-minute time frame, and say, where does this stock come from? Where does it have the potential to go? Does it look like it's finding a level of support here and maybe resting or just accumulating before it begins to rally? And if so, how much risk do I take here? I want to identify the risk reward. I want to start, I want to come up with my plan basically. On the intermediate term time frame. Then I'll look at a shorter term time frame, and that might be a 10-minute or 5 minutes, sometimes 2 minutes. People say, what time frame is your favorite? And I like to say all of them. I like to consider them all. So for a swing trade, primarily I look at a daily just to see what's the overall trend. Intermediate term, either a 65-minute or 30-minute time frame. And then the short term, I'll look at a 10-minute, and generally I look at 10-minute data for 10 days, 5-minute data for 5 days, 2-minute data for 2 days. It just kind of keeps the scaling so you can, so the candles don't get all squished together. And by the way, I don't have any special or favorite candlestick patterns. I'm not a big believer in candlestick patterns. To me, you can see the action of the daily candle much clearer by looking at the shorter term intraday time frames first. So what we want to do, obviously, is, we're in this to make money, but we have to be prepared for anything. The most important part of your plan revolves around preservation of capital, money management, risk management. Know in advance where you're going to be wrong, and be prepared that if I'm wrong, it's not going to crush me. I'm going to have strategies to make sure that I don't get hurt badly. So when you're coming up with that, trying to assess your risk reward, don't do it based on arbitrary percentages. Instead, what you want to look at objectively on a chart is say, where does this stock come from? Well, has it, is it settled in and created a nice level of support and now it might be ready to advance? Or has the stock just rallied from, look the S&P 500? I mean, buying it yesterday on a breakout, did it make sense to buy a breakout past 110.30, the prior high, after the market in the previous 7 days had gone from 103 to 110 and 110.40? No, because you don't buy those types of breakouts because it doesn't mean you don't buy them, summarily dismiss them, but it's already expended a lot of energy. In an 8-day rally that went 6-7%, typically, it's gonna need a pause. It's getting the uneducated money involved at that point. So we look at a shorter term time frame instead and say, well, it looks like we're running into a little bit of trouble in here. We're below the daily VWAP. So no, it doesn't make sense. Where does it have the potential to go on the downside? So today we're below the daily VWAP all day. Where does it have the potential to go? Well, what you want to look at is, okay, because the primary trend is higher, we can still make money on the short side, but keep them realistic. Keep them to a day trade. Well, the SPY had an important level at 109. That was a prior support level from earlier in the week, roughly 109. It was the level of S2, and it was also the area of the rising 5-day moving average. So was there enough profit potential to short it below 110 with a stop maybe at 110.40? Was there enough profit potential to make a trade today? 40 cents to make $1? That's worth doing, but I think 40 cents is also too much. But ask those questions. Where does it come from? Where does it have the potential to go before it's likely to encounter either a source of supply, in the case of a stock that's advancing, a source of supply that's going to slow it down, or in the case of a downtrend and you're short, where is it likely to find some buying? Well, the rising 5-day moving average, maybe that daily S2 and the prior support level, those become the price targets. It doesn't mean you sell short and then put in your order at 109. It would have worked today, but that's just, the market's dynamic. Our plan has to evolve. Our plan has to change. The market is always giving us new information to deal with. We can't become, overly analytical about it, but we have to, have a basic thesis and say, is it still sticking within that general thesis? So the basis of trend alignment, what I look for is, one, on that daily time frame, I'm looking for, for a long candidate. I'm looking for an uptrend. I want to know the path of least resistance is higher. On the secondary trend, the intermediate term trend, that'd be the 65 or 35-minute time frame, I'm going to look at the 4 stages there, and I'm going to say the stock can be in stage 1, 2, 3, or 4 on the 30-minute time frame, and still be in an uptrend on the daily time frame. If it's in a stage 4 decline, meaning a pullback within the primary trend, well then it means I want to avoid that stock. Again, I could make money selling it short, but the sum of the rallies are greater than the sum of the declines. Or if I'm going to sell it short, I'm going to go down to a 1 minute time frame and day trade it. I'm talking about swing trades here though. If it's in stage 1 accumulation, then I start to get interested. I look at it and say, well, on the daily time frame, it's in an uptrend. It just had a rally. It's pulled back on light volume relative to the recent advance, and it's near this rising 20-day moving average. Now it's starting to accumulate here. So now I look at it and say, well, if it makes a higher high, then I want to buy it with my stop below the prior higher, the highest, most recent relative, relevant low. So I want to start to plan my trade when it's in that accumulation. I don't want to be chasing things. I don't want to, but when it breaks to a higher high, then I want to get involved. That's time for me to get into this stock because the buyers are starting to re-exert their domination of the trend, and there's more demand coming in for this stock or the market in general. And when it starts to distribute, then I want to get out. So a short-term time frame, again, is just to kind of fine-tune it. So here we see a stock that had undergone distribution, decline, accumulation in here. It made a nice volume move past this, up to this prior high. It pulled back on lighter volume, held the 10-day moving average. Then it rallied again on increased volume, pulled back down, held that 20-day moving average. So if we look at this stock at the boxed-in area, after this initial rally, we missed that, let's say, then we see it start to pull back. Here's what we would be looking at. This is the same exact stock, but we're just looking at it from this, basically from the low of 32.5 up towards that 34.57 close, or close to there. So here we have the accumulation on the 30-minute time frame. This is a 10-minute time frame. We have accumulation. We have that higher high. Now, where would we set our stop? Underneath this low right here, okay? And as it continues to rally, we keep putting our stop underneath those higher lows. Here's a moving average exit, or we could have exited on this lower low right here. The stock pulls back. It looks like it's going to rally here, but the longer-term moving average on this time frame is still declining. We want that to flatten out to begin to turn higher like it does over here. So we want to be capturing these pieces of those trends. We want to be involved when the trends are aligned. Okay, so on this, we have a stage 2 uptrend on the daily time frame, but we don't want to buy it on a pullback. If we're buying a pullback, maybe it keeps pulling back. Maybe it just fails altogether. We simply don't know. Let other people do the dirty work of putting in that first higher low, of letting the moving averages cross. We're stalking the trade in here. There's no reason to be involved where we don't have momentum. The momentum buy is here. Now, if you're looking at option strategies, obviously you're going to want to adjust accordingly to whatever it is, that strategy that you might want to put into play here. But obviously there's so many option strategies that you could use. And again, that's not my area of expertise. What I like to do is buy calls here, get out of my calls, buy some calls here. If we're within that last week to week and a half of expiration. The beginning of an option cycle, you just generally don't get enough movement. For short sales, it's just the opposite. So what we're looking for is a stock in a stage 4 downtrend. We're looking for a stock in the decline. We're on the secondary trend. We're looking for a stock that might have just recently had a little bit of a rally up, and we're looking to see the stock decline from there. So let me show you a stock that I was involved in today, and this is EXC. EXC on the weekly time frame. We're just here we have back and forth activity. We're breaking support here on the daily time frame. What stage are we in? We've got a declining 10, 20, and 50-day moving average, also below the 200-day moving average. So this is something that I had identified last night on my website and said to subscribers, here we are in a 30-minute time frame. We've broken below the 5-day moving average. We want to sell it short on weakness right here, below 46.90. So when we drill down to a 5-minute time frame, we can see here that it broke that 46.90. Our stop was at 47.30 right here. And today, it broke down quick, rallied up to the 5-day moving average, and then just a real nice, as we wanted to cover half of it at S2, but real nice continuation. So we had on here, we were anticipating and then we participated when we had that lower low right here. Where did our stop go? At the most recent lower high, just above that. Because if we're selling short, we want the stock to be doing what? Making lower highs and lower lows. Well, if we get involved on the lower low, that's the first part of the plan. But if the stock rallied up like this, up through that high, well, then it would have made a higher high. That would have invalidated the definition of trend. So why get involved there? We've seen a lot of stocks doing that recently that look like they're on the edge of disaster. Okay, Nuva breaks down, rallies up on light volume. It never gave us a reason to sell short in here. If it had, we would have been involved. But it was still above that rising 5-day moving average. This was on our watch list, but it just exploded higher. CMG is another one that did that. Looked like maybe a bearish flag forming here, broken down. This is why, though, we wait for momentum. It was holding that 5-day moving average. If it broke below here, we were looking to get short. It didn't break below there. So from the failed breakdown lower came a fast move higher. And that's what risk management and trend alignment are all about. We want to wait for evidence on all the time frames before we get involved. That way we can manage risk and be involved at the right time. So I won't go through these slides here. You can look at them yourself. But this is basically what we want to take advantage of. And the reason I said I'm not going to go through those is because I just took you through the more recent examples from today's trading. And also take a look at that BG, which was Bunge Corp. But trend trading to me is what it's all about. I just don't have the patience for stocks that don't move. I don't have the mentality that I'm collecting rent for a stock as some option strategies will do. To me, it's about finding a stock, saying what's the path of least resistance, because that's what trend trading is all about. But the big money is made if you can correctly follow the primary trend. Correctly follow. Just getting involved in it, isn't good enough. You can't look. You can't be looking at Apple and saying, is Apple a good buy at 210? Well, where has the stock come from? Apple has come from, in the last year, from $80 a share up to 200. Where does it have the potential to go? Well, nobody knows. It's at all-time highs. But, risks are greater here, obviously, than they were when this trend, of 120 points began, 9 months, 7, 10 months ago, whatever it is. But the longer-term trend is nothing more than the sum of a bunch of shorter-term trends. So when you think of it that way, the short-term trend tends to lead the longer-term trend. Now, the S&P 500 broke down a little bit today. Is that going to lead to a reversal? Not likely, because we have such a powerful longer-term trend. It's a one-day thing for now. It could be the all-time high. We'll know. We'll know in 6 months. We could look back and say, "Wow, I should have just held my short that day." That's what That's what amateurs do. The professional says, "Here's what I'm looking for today. I'm looking to make a good trade based on risk reward, based on logic, not on emotion. And we want to buy the strong stocks and we want to sell the short stocks." But when do we do that? Well, we do it when the only way we can do it is, others have to buy after us if we're going to make money on a long, and others have to, sell the stock after we short it in order for us to profit. So the only way we can do that is to anticipate. We have to anticipate the different scenarios, like last night with that EXC. Anticipate, well, I'm going to short it below 46.90. If it gets back up above 47.30, though, I'm going to cut my losses because maybe it goes to 49.50, $60 a share. I don't want to accept those losses. So what we want to do is we want to anticipate all potential scenarios and then wait for price confirmation before we actually participate. Because if we jump the gun, like in trying to short CMG, it can go 8 points in our face over the course of a couple days. The idea is to find the low risk, highest probability trades by using multiple time frames. And in an hour, that's basically it. Okay, so I realize there's a lot of information there for you. Follow me on Twitter. It doesn't cost you anything. Use the @ Alpha Trends. And at this point, I guess I don't see where the I don't know if I have access to the questions or not. Um,
You do have a questions tab underneath the attendees. You see where it says attendees, there's these little square file
I do.
boxes.
Yep. Yep.
Take that questions box and click on it,
Pop
and
it
it's going to
out.
pop open.
Yep.
And then you can
Okay.
drag it open, and you'll see you have a few from Tina, Juliana, Deanna, Dawn, Steve. They're rolling in.
Okay. So these the questions it looks like began at 2 p.m. Is that right? Or
You'll
2:11
need to scroll down to, well, yes, your time, my
is what
time
it's
is
showing here.
3:11. Yes, I'm
Okay.
3:11.
Okay. So Tina is saying average to range. I don't use that, Tina. Second question from Tina is the moving averages on your shorter time frame, are they based on the number of bars as opposed to number of days? Number of bars, correct. When you're looking at, for instance, I talk a lot about the 5-day moving average. So if we're looking at the average price of the last 5 days for Apple, what we want to look at on a 30-minute time frame, for instance, is again there's 13 equal periods of 30 minutes each day in the market. So over the course of there's 13 of these 30-minute periods. So if we're looking at a 5-day moving average, we'd say 13 times 5 days. A 65 period moving average, that's this up here, 65 period moving average is equal to a 5-day moving average that we would see on a daily time. So that's represented by this orange line. Next question is from Juliana. Could you repeat the moving averages, please? On a weekly time frame, Juliana, it's a 10-week, 20-week, and a 40-week, which a 10-week would equal to a 50-day. A 20-week would equal to 200 days. On my daily time frames, I typically look at a 10, 20, and 50-day moving average. And on a 10-minute time frame, I look at a 20, 50, and 100, but put most weight into the direction of the 5-day moving average, which in the case of a 10-minute time frame, now we were looking at 195 10-minute periods, because over the course of 5 days, the market's open 1,950 minutes, which is equal to 30 times 65 as well. You've talked about bull and bear traps. Can I elaborate, please? A bull trap. Okay, great example this year was in the S&P 500 when we had this this head and shoulders pattern that everyone was talking about. What happens here? We have this head and shoulders pattern. Okay, real obvious to a lot of people. Technical analysis 101. Anyways, people were looking for the market to completely fail. The measured move would have taken it down towards this level. It broke the neckline, and then what happened? Well, what happened is the weak longs basically get out of the market in here. They're stopped out. They're looking at going, we've got a lower low. We're below a 50-day moving average. We're breaking this neckline. Get me out of this market. Short, and then other people are looking at going, oh, this thing's juicy. It's going to cave in. I'm going to sell short a bunch. So they sell short, but wait a minute. The next day, the market rallies. What's happening to those people that threw their stocks away, the longs that got rid of their stock? What's happening to those short sellers? Well, they're trapped. They're trapped now. Why are they trapped? Because we've gotten rid of the supply in the market. The sellers that wanted to get out got out. Now the people who are holding realize, hey, these guys are trapped in here. I'm not just going to give it away for a 50-cent gain. I'm going to hold on. I'm going to be stubborn. I'm going to try and make a lot of money on this. So they're going to have to chase this higher. So we have less demand and we have more supply because we have momentum money coming into the market. We have those longs that threw their stock away coming back into the market to reestablish their positions, and we have the short sellers, and they're going, "Whoa, wait a minute! I got to get out of this. The only way to do that is to buy." Who are they going to buy from? Well, we have all this demand and a lack of supply. So those failed moves, from these failed moves, often come very fast and violent moves because we've got so many people trapped. Don's asking about the moving averages, and I just covered that for Tina or Juliana. How do you find stacks? Brute force review of stock charts? Yes. Steve, I look at hundreds of charts a day. Are the M the only indicators you use? I don't know what the M means, but the moving averages maybe. I look at price, volume, moving averages, and time. Time, multiple time frames. Please talk about the setup you use for short-term day trades and swing trades. VJ, that's just too in-depth for this. I can't. I'm looking for the same things I talk about, but on shorter time frames. I'm looking for a market below the daily VWAP. I'm looking for lower highs and lower lows. I had, been involved in BG as a short sale trade today. Getting involved in this one. I was short EXC today, and I day traded those. So I've talked about those ones. So hopefully that gives you a little bit of an idea. Moving average for the 1 minute time frame. That's a volume-weighted average. Volume-weighted average price, VWAP, is what I use on the 1 minute time frame. It's not time, but it's weighted based on volume and price, not time. Do you have a scale with all the time frames and moving averages? I do, Gabrielle, and that's in my book. You can get that at technicalanalysisbook.com. There's my one and only pitch. Please talk about trading options expiration week. I did. That's when I like to trade options, VJ. And again, this is an hour-long session. Some of these questions could go on an hour themselves. VJ is also asking about scanning. And again, it's my own two eyeballs. Tina's, do you normally compare your equity charts to the sectors? I'm aware of the sectors, but within each sector, there's leaders and there's laggards. I like to trade each stock based on its own individual merits. But if the sector is real weak, I'm generally not going to get long one of the stocks. Or if I do, it'll be a stock that's trending higher, but I'll be extra vigilant about risk. I'll trade less share size, and I have lower expectations because the sector may not be showing the same same strength that I'm finding in the individual stock. David's asking, where can you purchase your book, and do you primarily use moving averages and volume? Well, thanks for the question. That was a layup for another mention of technicalanalysisbook.com. And I primarily use price. Price is, price, I say it all the time. Only price matters. People have been talking about the volume in this rally for the last week and a half. The volume stinks. I don't trust this rally. It's a sucker's rally. Well, the suckers just made 7%. Well, you've been trying to short it because of low volume. Only price pays. Volume does matter, but relative to the event and that sort of thing, that's the way I look at volume. But price, volume, moving averages, and look at all these time frames I have up here: monthly, weekly, day, 90, hour, which is really 65, 30, 15, 10, 5, 3, 2, 1, even a tick chart, which I rarely look at, a tick chart that is. But those are what I look at. Moving averages, simple or exponential. Simple because that's what most people use, and it's not a system. They're going to be in this same general place anyways. You're going to see the 5-day simple exponential moving average and the simple moving average in within a few pennies of each other, and it's not a system. It's merely a moving average is a reference point. It's a constant to compare price to. When I see the market approaching, at the 50-day moving average, I don't want to buy there. I want to say I want to look for evidence on the shorter term time frame that the buyers are gaining control. You could have made money buying right at the 50-day moving average there. You could have made money here, but you'd have to wait, to do it. So it's just a reference point, something to compare price to. So VJ is asking the same thing, simple or exponential. And Gabrielle just typed in the last question. Actually, Steve did. All right, Terry, that's it. Anyways, I have other responsibilities here. I'm sorry. Let's see. Great presentation. Thank you. Do you normally day trade during expiration? I day and swing trade. Just because options are expiring doesn't mean I need to swing trade or day trade. But I like to swing trade options on expiration week because it's a low risk way for me to gain directional exposure for a short period of time. Tina's read my book. Thank you. Gabrielle's asking, do I think the rally's over? No, I mean it's innocent till proven guilty. Maybe I'm wrong. Maybe we're still in an uptrend. To me, it's foolish. Every time we get to a new high, people are calling it the high. We're at level. We've had a great rally. We could still potentially rally up to the 50% retracement. Maybe that's going to be the high. Maybe we're going to go all the way back up to the 2/3 retracement at 122 and fill in this big hole right here. I don't know. You got to take it just a little bit at a time and say, all right, we have weakness on a 1 day, over 1 day. On the 10-minute time frame, we still have a good trend. That's not broken yet. So, you have to listen to the market rather than impose our belief. The market doesn't care whether I think the rally's over or not. Steve is asking, what about Forex? I don't trade Forex, Steve. I've never been interested in it. I don't like macroeconomics, I guess. I'm not interested in what the yen and that. I'm not interested in the ECB and what they're doing with interest rates. So I've just been an equities guy. That's what I'm good at. So that's what I stick to. When will technical analysis book be available? .com be available? I don't know. Maybe my website's down, but it's always available. It's been online for quite a while, but technicalbook.com is it's available right now. I mean, it's a website. Here's the website. This is it. You can look at a few sample pages in here too. This thing's kind of fun.